Well, we just finished presenting worksheet 2 for the IMC plan, creating it. We've got our numbers and they look good. We've got a positive NPV. It's already looking better than the original scenario. But let's try and do an official comparison. So we're going to add a new spreadsheet and it's put in the wrong place. So I just pick it up with my little arrow, my pointer, and drag it to the end. And here, in order to compare, we need to look at NPV of original plan, of the IMC plan, and the NPV of the original plan, and the difference. So let's give ourselves a little more space here. I'm going to go ahead and refer to that. So equals, and the NPV of my IMC plan, I can just go to that spreadsheet, highlight it, highlight the thing I need, which is this NPV, and hit return. And voila, it picks it up. So let's do the same thing for the NPV of the original plan. I put an equal sign, I click on the original, and I click on the NPV, and I hit return. And it knows to go to that spreadsheet to see what happens. And my difference is my IMC plan minus the NPV of my original plan. Ooh, a $304,000 difference. So this is a good idea. The business will be $304,000 in net present value ahead by going with the IMC plan versus sticking with the original plan. But let's say that your boss doesn't understand net present value, and sometimes that occurs. So now you have to look at what would the return on investment be if you had did the IMC plan versus you not doing it. Well, we don't have an ROI for the original plan. As you recall, that one was not available because we can't divide by 0. So let's tackle it a different way. Let's figure out, we know what our NPV is for each plan. So, and therefore we know what our difference is, so we can get that. Let's find out what the difference is in our initial outlay, and we might be able to do difference to difference. So our initial outlay IMC plan is equal to, let's go to our IMC plan, $115,000, and we pick it up right there where we calculate it for ROI. And the initial, outlay for the original plan we know is 0, and we can get there by equals, and we don't actually outline it. Oh yeah, there it is. There it is. It's a 0, but we don't actually have it here, so we'll just go ahead and put it in as a 0. So the difference is our initial outlay for the IMC plan minus our initial outlay for the original plan, which is $115,000. Great. So the ROI of the incremental investment, ROI, incremental investment equals your NPV divided by, so your difference actually, your difference in NPV divided by your difference in initial outlay. There we go. And we're going to go ahead and wrap the text here and wrap the text here. So we've got plenty of room. In here we're just going to have, so we take our difference in NPV and we divide it by slash our difference in initial outlay. And that's 264%. Express it as a decimal point, and it is 265%. Let's say I want to be more precise. I can get more decimal points, and it's 264 and 81. So 264.81%. That is a great ROI for the incremental investment. And then finally, we needed to look at whether or not to lease or buy. But let's go ahead and label this worksheet to incremental effect. I think here we can demonstrate to Mo that he really does want to do the IMC plan and promote Watson because it's a good deal. Now we've got to go ahead and figure out whether we want to lease the equipment or buy it, or because we've already owned it, figure out how much it would cost us. So the first thing we're going to do is take our IMC plan, because that's the plan that we're going to compare it against, because we're definitely doing the IMC plan. So we hit copy, we go to sheet 4, and we hit paste. And the only question that we're dealing with is whether to lease or charge ourselves for the opportunity cost of the equipment. So let's go ahead, Alt and insert an opportunity cost of camera, of old camera. And in this case, the old camera was worth, it originally cost Mo $200,000, but that's not what we're going to use. We're only going to use the $80,000 because that's what somebody would be willing to pay for it now. So that's $80,000, and that's going to be an additional outlay. So let's go ahead down here below the line and initial outlay opportunity cost for the camera equipment, and that is going to equal that $80,000. Now the other thing we need to change is, so let's go ahead and highlight that in a new color so that we know that we've changed that. Let's use orange. And we've added this line, so we'll go ahead and use orange there too. The only other thing we need to do is change the number of cameras we'll be leasing. Remember up here we had added a number 2 for the camera? Well, let's go ahead and take that back to just 1, because only Mo will be leasing his equipment and he will be using his old equipment, which has an opportunity cost of $80,000 in the initial outlay. So this camera lease drops back down to 20 from 40. That's good. This doesn't look right though, our total operating cost. And the reason it doesn't look right is that if we double click on it, we'll see that it's only picking up the 66, row 66 through 52. And what we really wanted to do is pick up another row. So we wanted to pick up this row all the way up to 52. Hit return. Let's try that again. Auto sum. Yep, there it goes. 195. And that becomes our new initial outlay. Now, we've got an initial outlay total of 195,000, and we've got a new cash flows of 147, or yep, I can't really read my handwriting. So 160, 556, 151, yep, those all look right compared to the sheet we had. Our operating expenses all look correct, 147, 156, great. So our present value of our cash flows, notice because we made it all formulas, we don't have to worry about that. That's already picking up all these new numbers and still using the 7.2%, so that's kind of handy. The net present value of this scenario is $299, which is kind of interesting because if we go back, let's go back and up. So for comparison purposes, NPV of leased camera worksheet 2, and we can wrap that text if we want so that we don't lose it, is equal to, we go to worksheet 2 and pick up, scroll down, find our NPV, there we go. We can quickly see that the NPV for the leased camera is slightly higher than the NPV for using the old camera. So while it seemed like a great idea to use equipment that you already have, in fact, it actually works out to be a better deal for the company. It increases their value by about $2,000 to sell that old equipment to Randy for $80,000 and instead lease the camera. Because this scenario, which has us using the old equipment and leasing only one camera, has an NPV of $299, whereas if we lease 2 cameras and don't use the old equipment, it will give us a net present value of $301. And that is how you make that comparison. Thanks very much for hanging with me. This has been a fun project and I've enjoyed making these videos for you. Thanks.